see that there's obviously a lot of interest in what you announced today, and please, you have the floor. And I want to say that after this we have questions, one question, one follow-up, and we have to be strict and shortly before 12. You have the floor.
Well, good morning. Bonjour tout le monde. Senior Deputy Governor Wilkins and I are pleased to be here to answer your questions about today's interest rate announcement and our monetary policy report. Today, we raised our key policy rate by 25 basis points in the context of an economy that is approaching full capacity and with inflation expected to reach the 2% target within the next year. Aujourd'hui, nous avons relevé notre taux directeur de 25 points de base dans le contexte d'une économie se rapprochant de son plein potentiel et d'une inflation qui devrait atteindre la cible de 2% au cours de la prochaine année. Now, before we turn to your questions, let me offer some insights into Governing Council's deliberations. Economic data have been encouraging over the past few months, globally and especially for Canada. We acknowledge this positive trend in our April NPR and in our May 24 press release, while noting concern about the sustainability of growth because of its composition, as well as U.S.-based policy uncertainties. While uncertainties remain, delays in decision-making in the U.S. seem to have moved some of those concerns more into the background. The bank's latest Business Outlook survey, for example, finds very strong business sentiment, particularly for investment and hiring intentions, despite a lack of clarity about future U.S. policies. Since April, we've also seen further evidence of a broadening of growth in Canada. Along with stronger than expected growth, this has bolstered Governing Council's confidence in the outlook for the economy and inflation. The economy is absorbing excess capacity more rapidly than we projected in April, and it now appears that the output gap will close around the end of this year. That will, nevertheless, leave some slack in the labor market. As output growth continues to exceed potential, we expect companies to invest in additional capacity and draw from this slack in the labor market, thereby expanding potential output further. Ce processus est difficile à prévoir, mais il devrait être de plus en plus évident à mesure que nous allons nous rapprocher du plein potentiel. C'est là une raison importante pour laquelle la politique monétaire ne suit pas une trajectoire prédéfinie. Elle restera très dépendante des données à l'avenir. L'un des indicateurs clés des progrès accomplis demeurera le rythme d'augmentation des salaires. Il a montré des signes de redressement ces derniers mois, mais est encore limité par les effets persistants de l'ajustement au bas prix du pétrole. Meanwhile, inflation has continued to fluctuate in the bottom half of our target range. This has prompted a lively debate, not just in Canada, but in many other countries, about the appropriate interest rate setting when economic growth is rapid, but inflation is low. Governing Council examined this issue closely from two perspectives. The first asks whether there are special factors that are temporarily pushing inflation lower. And we discussed this issue in a technical box in the NPR. Generally speaking, central banks prefer to look through temporary factors. Of course, our new core measures of inflation were developed to help us see through the noise in inflation data. But even these are not immune to temporary fluctuations. After careful assessment of the evidence, Governing Council agreed that a significant portion of the recent softness in our measures of inflation should prove to be temporary. Nevertheless, even a one-time price change affects inflation for a year, simply because we gauge inflation on a year-over-year basis. Some temporary factors are themselves gradual rather than one-off, such as increased competition in retail food stores. So this all serves to underscore the data-dependent nature of monetary policy. Tout bien considéré, le Conseil de direction juge qu'en absence de facteurs temporaires, l'inflation se situerait autour de 1,8%. et parce que, selon les estimations, les capacités excédentaires au Canada expliquent un écart d'inflation d'environ 0,2%. Par conséquent, à mesure que l'écart de production se refermera au cours des prochains mois, l'inflation devrait se rapprocher de 2%. Le rythme de convergence sera déterminé par la vitesse à laquelle ces divers facteurs temporaires vont s'estomper. Our projection shows a modest overshoot of the 2% inflation target in 2019. This is a product of the dynamics of our model, but it's an important reminder that while our target is 2%, our control range is a symmetric 1 to 3%. Having a target range acknowledges the uncertainty inherent in economic forecasting and inflation control. The chances of an overshoot will depend on how investment and potential output respond to tighter capacity constraints, a process that the bank will monitor closely. The second perspective on the low inflation issue concerns the lags between monetary policy actions and their ultimate effects on inflation. It's worth remembering that it can take 18 to 24 months for a monetary policy action to have its full effect on inflation. This means that central banks must target future inflation by anticipating future deviations from target. And because inflation is measured with a lag, reacting only to the latest inflation data would be akin to driving while looking in the rearview mirror. In contrast, imagine a world where the bank was able to anticipate all future movements in inflation and adjust interest rates in advance to offset them to keep inflation exactly at 2%. Well, in such a case, it might appear to the casual observer that interest rates were being adjusted up or down for no reason. En tenant compte à la fois de l'écart de production qui va se refermer prochainement et de notre compréhension des chiffres récents faisant état d'une inflation faible, le relèvement des taux d'intérêt aujourd'hui est nettement justifié. Cela dit, il est évident que nous allons examiner avec soin la dynamique de l'inflation afin de déterminer dans quelle mesure il demeure approprié de faire abstraction des fluctuations de l'inflation. Interest rates were lowered in 2015 in order to help the economy adjust to lower oil prices, and much of that adjustment is now behind us. While lower rates contributed to greater household financial vulnerabilities, enhanced macroprudential policies help to mitigate these and will continue to do so. As the economy approaches full capacity, a higher policy rate in pursuit of our inflation target also serves to reinforce efforts to mitigate financial system vulnerabilities. Governing Council acknowledges that the economy may be more sensitive to higher interest rates than in the past, given the accumulation of household debt. We'll need to gauge carefully the effects of higher interest rates on the economy. Future adjustments to the target for the overnight rate will be guided by incoming data as they form the bank's inflation outlook, keeping in mind continued uncertainty and financial system vulnerabilities. With that, Senior Deputy Governor Wilkins and I will be happy to take your questions.
Thank you very much. And I have already 10 colleagues on my list. And the first question goes to Craig Quinn from Bloomberg. Please.
Good morning. You're an inflation targeting central bank that's cutting interest rates as inflation is slowing, and especially the core rate. Why are you comfortable or confident in taking this approach? Pardon me, raising interest rates. It's been a long time.
Well, as I said in my opening statement, there are two lenses through which to look at this. The first is that if we have solid explanations for why inflation is weak or has weakened, then it's our intention always to look through those fluctuations. And there's extensive material in the NPR, which I won't replay here, but Ms. Wilkins may have a couple of comments about that. The second and probably more fundamental reason is that as also as in the opening statement, we need to be targeting inflation in the future. So it's about where we expect inflation to be, because any action we take today is only going to have its full effect on inflation over the next 18 to 24 months. So we need to be looking out there, and the metaphor that Carolyn has used in her speech recently was you ease up on the accelerator in your car in advance of getting to that red light. But that, of course, means that there's a chance that the light will turn green by the time you get there, and you'll never have to step on the brakes. And so the other side, the equivalent argument in that metaphor is that managing this process in the way we are here raises the odds of a sustained expansion, one that does not require actually stepping on the brakes. Do you want to add something about the inflation detail?
Well, I just think we look so carefully at what's driving inflation, and in particular why it's lower than 2 and why the core measures and total inflation have decelerated over the last couple of quarters, and that's pretty important, because if it's just transitory, it means it's gonna fall out within a year, and with the output gap only subtracting 0.2 from inflation. That means that then inflation should go back to 2%, and we need to take that into account. Now, of course, when we look at consumer energy prices, what happened in Ontario, for example, and then we look at the dynamics of auto prices, that's all in box 2, it gives us a pretty convincing explanation. At the same time, we're going to look at the data to see if it's borne out the way we think. I mean, there is a possibility in the risks that we've highlighted at the end that, in fact, some drivers of inflation might be more persistent. For example, the output gap could be bigger than we think it is. Or some of the global forces that people are talking about, whether they're with respect to e-commerce or digitalization, they could be playing a role that's more important than we think right now. Of course, that's not our base case, but that's something that we'll be looking at.
Secondly, looking back at the cuts in 2015, a lot of people in the market didn't see that coming. This time it seemed like there were a lot of clues in advance that you might be doing what you did today. Has something changed in the way you're communicating with Canadians, or is this something that changed in the way the economy was unfolding?
No, I think it's business as usual. If we go back to late 2014, I recall Tim Lane giving a speech that analyzed very carefully the evolving oil price shock well before the January announcement. It was stated there that it would be unambiguously negative for the Canadian economy and those kinds of things. And all of course, on our website are plenty of work with our models about shocks like that and how the economy reacts. So I think going back to that, I think of course things move fast, and there was a certain amount of surprise. I understand that. Here, we have come into the habit of giving a speech in between meetings, which is given the title says the word update, which is Ms. Wilkins' speech in Winnipeg. So it was an economic update, and in that we transparently described how we were seeing the latest data. And so I think people picked up on that and said, well, looks like the bank's view is evolving. Well, as everyone else's was. So, I mean, everybody looks at the same data, and that's, for us, the ideal setting is where everybody's looking at the same data. Everybody kind of has a similar understanding of what's going on, and wouldn't be hanging on the bank's every word.
Andrea Hopkins, Reuters, please.
Governor, there seems to be two schools of thought that are forming with this first rate hike. That this is the first step in removing that 50 basis points of insurance that you imposed in 2015 amid the oil shock, or that it is the start of a series of steps upward. Which is it?
Well, I would say there's no simple answer to that. When we moved further in 2015, we were taking into account our best judgment around the impact of the oil price shock to soften that blow, and speed up the economy's adjustment back to the track that it was on before the shock. If that were the only thing that had occurred over that whole time frame, then we could say, well, mechanically then you need to remove that insurance. But so many other things have changed in the meantime that you can't take the end of 2014 as any natural point of departure for that analysis. So I think the most important thing here is that the economy clearly no longer needs as much stimulus as we've been giving it. But at the same time, we're letting you know that the world has changed enough in recent years, in particular indebtedness of households and so on, that the economy may behave slightly differently compared to the average behavior over time, i.e. what's in our models. And so we'll be monitoring carefully how the economy continues to adjust both to fundamentals and to higher interest rates. So I'm hesitating to classify it as either one of those stories, just that our assessment is that the economy can handle very well this move we have today. And of course, you need to preface that with an acknowledgement that, of course, interest rates are still very low. So people need to understand that in the full course of time, I don't doubt that interest rates will move higher, but there's no predetermined path in mind at this stage. It's a data-dependent, quarter-by-quarter analysis that we'll be doing.
Then to sort of go back to the timing or the evolution of the bank's messaging, while this hike was expected recently, as 6 weeks ago it was not. What changed between 6 weeks ago and 5 weeks ago that caused the bank's tone to shift so dramatically? What happened to change your view, or is it that the market or the media missed previous signals?
Well, I'll just say that there's a whole lot of things that we could say about that, and I think probably the best person to discuss that is the person who gave the update. So, Ms. Wilkins, how about that? Go ahead.
You go back to April, and we had a forecast that said we were encouraged and that we wanted to see a bit more data, and particularly around the broadening of sources of economic growth. And in a case where we've been disappointed before, remember we made a call on the first quarter. We hadn't seen the data yet, and in fact we didn't get the data until after the May announcement. But then when we did get the data for the quarter, it was bang on overall our outlook, and in fact we did see some of the broadening that we were anticipating, which was encouraging. And then on top of that, we've had a couple of more labor force survey data that show the labor market's doing very well. We've seen at the same time some export data more recently that have been encouraging, and some monthly GDP data that show that broadening's not only occurring across demand categories but also across sectors. And it's quite interesting. There's a great chart in the NPR that just looks at the sources, the number of industries. I think it's about 70% of industries that are, or sectors that are growing now, and that growth is including more and more growth in goods industries. And so you put all that together and you take into account some revisions to the level of GDP, and you end up with an output gap that's closing a little bit sooner than we had expected in April. And I think, so the bottom line is it's the data that we got since May that has either confirmed or made us even more confident in the outlook that we have.
I would just add that we're not just forecasters, so for us it's not a game of getting the forecast right. We're policymakers, so for us to be more cautious than your average forecaster, I think makes perfect sense. That's our job to be very skeptical of short-term movements in data. And so that caution, was probably at its peak in January. Because of the uncertainties that the U.S. election posed for the economic outlook. And so it's more a question, not so much, there is an upward revision, of course, to our outlook because of the data that Carolyn mentions, but More importantly, it's our confidence that has increased through those months compared to where we were at the beginning of the year. So it's that confidence in the outlook which makes us more confident today to make the change we've made.
Paul Vieira, Wall Street Journal, please.
Good morning. How much did financial stability concerns influence the policy decision today?
Well, financial stability is always present on the table as we discuss these things. As we discussed back in 2015, when people were asking, well, how can you consider cutting rates when household debt is so high and all that stuff? Won't that make that situation worse? And we offered up a pretty detailed analysis of that, and the answer is yes, but our primary mission is to help the economy absorb the shock, get it on track so that we can get back to equilibrium sooner than later. And that was the best contribution the bank could make to the sustainability of the indebtedness that we saw out there. And that really, if the concerns were higher about actual financial stability, financial vulnerabilities, we needed more macroprudential actions to help manage those. So that was the combination which basically was delivered. And now that we've kind of turned the corner and we have the economy in a place where there's finally a two-sided risk to your outlook as opposed to just concerned about downside risks, now you're in a position where, yes, interest rates have moved higher today, and that's, of course, working in the same direction in terms of helping to mitigate financial vulnerabilities. So always present, but at times it takes more of a backseat just because your primary mission is to get inflation back on target. Today we can say that there is a very reasonable expectation that our inflation will be on target within a year. And given that base, we can also look at financial vulnerabilities and say, yes, it is appropriate today that interest rates rise for both reasons.
You just talked in the opening statement about how some of your concerns have now have moved to the background, given some slow movement on U.S. decision making. Have you discounted some leading up to this decision? There was some thought that maybe you've discounted the risk of uncertainty about U.S. trade policy given the NAFTA renegotiations. How key a concern does it remain, or risk in the outlook?
Well, for us, the main channel for this is through investment decision making in the economy. So if your business depended totally on NAFTA, would today be the day you would spend the money you'd accumulated in order to expand, knowing that possibly NAFTA would change? So that uncertainty, I think, remains. Certainly it's very prominent in our BOSS survey. It's one of the first things that people say, that they still don't know what's going to happen. And it's not just trade, but also would there be a fiscal shock of some magnitude in the U.S. So some of these effects we had modeled back in January just because financial markets had really embraced, in particular, the fiscal shock from the U.S. So it would be odd to have a forecast that had interest rates that, in effect, contained a fiscal shock, whereas your real forecast did not. So we tried to incorporate some judgment to make those things consistent internally in our forecast. And the change that you can see in one of the footnotes here today is that given the uncertainty about when or if that would transpire, we've decided to take it out of our assumptions. So for that reason, the U.S. outlook is slightly less vigorous, and you can see it in the export line, for example, in the Canadian table. But the uncertainties linger. I would just say that from our anecdotal evidence, we'd say investment in Canada is less today than it would be without that uncertainty. But people seem to be setting it aside and sort of getting on with things. So we're seeing a recovery, stronger investment, not as good as it would be without that, but still there is one. And that's kind of the balance what you're seeing here. And it means then that it's why the risks section of the back is quite important, because it's the kind of thing that when you get the clarity, could have a significant uptick in investment. People just suddenly have clarity about what things will be like. Or if there's a change in NAFTA that somehow has an adverse effect on certain sectors, then you could get the opposite. Carol, did you want to add anything to that? Because you really watch the investment side.
Well, on the investment side, I think the best we can do right now is take into account the confidence effects that you've just talked about, and also keep in mind that other than that, firms across Canada seem to be more inclined to invest this year. When you look at our actual investment profile, there's a couple of good charts. It's increasing its contribution to growth over last year. Couldn't do much worse given that investment was falling, but it's quite modest relative to the past. And maybe it's a good time to highlight, we have a working paper or a staff analytical note that we put out maybe a week ago that looks at investment in Canada and why it's been so weak. Looks at it globally, and it's a quite interesting paper because it finds, indeed, that the weakness in investment was due to the oil price shock, some population aging, stuff you would expect, but globally there is a little bit of a puzzle, and so that's why we're keeping it as a risk over and above what might happen with respect to NAFTA.
I want to suggest that we ask only one question so that more colleagues can ask questions. The next goes to Courtney Tower, please.
You say that business investment is on the increase or has that prospect, but there's precious little hard evidence of it, and the business outlook survey said that really when you get down to it, they're waiting and seeing until the uncertainties are removed or are dealt with in the United States and elsewhere. So I'm just wondering, and the question also applies to exports because they're related.
Right.
I'm just wondering where all the assurance comes from.
Well, we'll start with that. Investment. If you look at the data for the first quarter, investment was up a little bit over 9%. Now, most of that was due to oil rigs and related activity coming back online, and so from a level point of view, it's permanent, but from a growth point of view, we expect investment to slow. But if you look at kind of more recent data that indicate, aside from people's expectations, but you look at the hard data, imports of machinery and equipment weren't spectacular, but they are consistent with some growth in investment going forward, particularly in things that use machinery and equipment as inputs. And when you look at the survey that we get from the BOSS, they're not necessarily looking for big projects, but significantly more investment across a wide range of industries and provinces than we've seen in the past. And so on the export side, I think the BOSS is a good segue. You can see the Business Outlook survey shows the same kind of optimism with respect to growth in future sales. And part of that is because of expectations of increased demand from the U.S. But not only there, we've got a more synchronous global recovery. And so we've got Europe growing, sort of all the economies kind of rowing, Asia demand growing as well. So boats rowing in the same direction. And so I think that's what's on businesses' minds. I mean, from our point of view, again, our forecasts for exports and investment are very, very prudent. You can see in the data in our charts, and we've tried to take into account the uncertainty that's out there. But we do highlight the downside risks. And just the last thing on exports, we were really disappointed in Q1, that's for sure, with the unexpected fall. But the more recent data shows that exports are up across a wide range of categories, goods included. So there are some special factors. sales of gold, for example, but nonetheless, exports are off to a good starting point for the second quarter.
So the next question goes to Kevin, then Raoul, and then Mme, please. Kevin. Kevin
Carmack from Maclean's. The bank in the past has talked a lot about sort of chronic competitiveness issues. Given that, and given the fact that core inflation remains weak, given that you've listed a fair amount of at least circumstantial evidence of why there may be structural changes around inflation, around the economy's potential, is there a temptation at Governing Council to let the economy run a little hotter than you might have in the past? Is there an argument to be made that maybe you could test things a little bit to offset those competitiveness issues that have plagued the Canadian economy in recent years?
Well, given I would just say as a general proposition, whenever there's a long cycle like the one we've been living through, I think you're more attentive to legacy effects, if you like, what economists would call collectively hysteresis effects. So permanent scarring that may occur as a result of the long nature of the down cycle. And that would take the form of skills that degrade, perhaps, or there's enough structural change that people are no longer qualified to work, or actual exit from the workforce because of discouraged worker effects. And I've mentioned a number of times, the youth retreat from the workforce and this sort of thing. So these are all reasons why we think there's still some room to grow once the gap is closed. That gap is going to be closed in the next 6 months or so, right? So we're by the end of the year, around the end of the year, around the end of the year. So there's always this range around it. And so the next phase of that is much less certain, at that point I've just said is uncertain enough, how wide the range of estimates is around potential output. But the next phase is what we call the endogenous output recovery, okay? So that links up with firm creation and the investment story. And so companies we talk to say, I'm at full capacity now. So if it weren't for NAFTA, I'd invest now, but actually I have to invest a bit. So you get that sense of, yes, investment's going up, but I'm not all the way into it yet. So the more widespread that becomes, the more you add to capacity and you bring some workers from the outside, and that actually expands potential output and effectively delays the point at which it closes. So for now, we've tried to judge all that stuff, and our best estimate is around the end of this year. But frankly, there's decent chance that as we get into the hotter phase, as you would describe it, that more of that action will happen on the supply side of the economy. But it's not something we're comfortable forecasting. It would be good news as it occurs. And it's arguably that's how you could interpret how things have gone for the U.S. over the last 18 months. So there's been a process of very careful, graduated movements, while the labor market has continued to outperform most people's expectations. And I think underneath that is a story similar to this.
I apologize that I didn't call colleagues who ask questions in French. I want to ask Mylène and then colleague there, please.
Oui, M. Poloz, j'ai une question par rapport à l'endettement des ménages. Jusqu'à quel point cette variable-là va jouer un rôle dans les prévisions que vous avez, les prochaines décisions que vous allez prendre?
Oui, ça joue un rôle, c'est certain, particulièrement en ce qui concerne l'ajustement de l'économie aux taux d'intérêt plus élevés. Peut-être, Caroline, pour élaborer un peu.
Mais c'est sûr qu'on fait nos prévisions. Nous tenons en compte le fait que les ménages sont endettés. Et une façon de penser à l'effet possible est vraiment de voir, mais on a une hausse de taux d'intérêt, puis on a des gens qui veulent acheter une maison pour la première fois. Et là, ils sont touchés tout de suite si les taux hypothécaires augmentent en même temps. Alors, ils ont le choix de soit attendre un peu plus, acheter une maison un peu moins chère ou de couper les dépenses ailleurs. Tandis que les autres ménages qui ont déjà une hypothèque, mais là, ça dépend de la nature de l'hypothèque. Il y a à peu près entre 75 et 80% des gens ont une hypothèque à taux fixe. Alors, c'est pas tout le monde qui va avoir besoin de renouveler leur hypothèque cette année ou l'année prochaine. Soit que si vous avez eu une hypothèque il y a 3 ans, vous aurez probablement un taux d'intérêt moins élevé au moment de renouveler. Alors, mais c'est pour les gens qui font face à un taux d'intérêt qui monte, c'est sûr que c'est de l'argent. Vous faites des calculs simples. Si on a une hypothèque à 100 000 $ et le taux d'intérêt monte de 2,75 à 3, c'est 12 $ par mois. Donc, c'est de l'argent. Mais il faut penser aussi, donc, on modélise tout ça pour voir l'effet. Ce que M. Poloz a dit au début, c'est l'effet un peu incertain, donc on regarde ça de près. Mais il faut voir aussi le contexte, parce que le contexte est dans une économie qui croît et dans une économie où l'emploi va continuer à monter, puis les salaires vont continuer à monter. Donc, c'est dans un contexte qui est quand même assez bien. Et puis, c'est nécessaire aussi pour retourner un taux de croissance qui est plus équilibré, qui est conforme avec notre cible d'inflation.
Et est-ce qu'on peut vous entendre sur l'incertitude américaine en français? Vous en avez parlé beaucoup en anglais, l'incertitude due aux politiques là, aux États-Unis, de protectionnisme, entre autres.
Oui. L'incertitude continue, mais nos enquêtes suggèrent qu'il y a du monde qui pense que la réalité est que c'est une certitude, mais on voit un certain délai des décisions, etc. Alors, c'est difficile de les incorporer dans le plan d'affaires. Alors, il continue avec la vie, mais avec l'incertitude qui reste là. Alors, c'est juste la vie. Peut-être il y a des changements ou non. Pour le moment, on ne sait pas.
Yes, please.
Canada. Bonjour, M. Poloz. Vous l'avez dit en anglais, l'ajustement lié à la chute du prix du pétrole semble être terminé. Est-ce qu'on peut donc s'attendre à d'autres hausses dans le futur, donc par exemple une hausse à l'automne?
Oui, je ne vais pas donner une prévision des taux d'intérêt. Et ce qu'on a dit clairement, que c'est une question des données. Le processus dépend directement aux données économiques. Et pour le moment, nous pensons que c'est approprié d'ajuster le taux d'intérêt aujourd'hui. Mais à part ça, chaque réunion sera une page fraîche.
Pour revenir sur l'endettement des ménages, à quel point l'économie est-elle vulnérable par rapport à ça, l'économie canadienne, par rapport à l'endettement assez élevé des ménages? Mais
comme on a dit, dans le contexte de notre FSR, c'est vulnérable maintenant, c'est vulnérable depuis longtemps, en effet. Mais c'est la vulnérabilité, c'est une question de choc. Quel est le choc qui touche cette vulnérabilité, qui change la vulnérabilité en un risque actuel? Et si le contexte continue à améliorer, comme Mme Wilkins l'a mentionné, ce contexte améliore et ça réduit les risques en même temps que la vulnérabilité sont en hausse. Alors, c'est un contexte qui est très important pour analyser cette question. C'est ambigu, malheureusement.
You, please? Or
Yeah, sure.
Yes, please.
Karina Roman, CBC. When we talk about the economy improving from a political standpoint, the government might finally be able to see what we're doing is working. Do you think that today's hike gives them that platform to boast that?
Well, I think the most important thing here is that this is good news for Canada, that the accumulation of evidence and the growth in our confidence that the economy is on a solid trajectory should be good news for everybody. I know not everybody will think a higher interest rate is good news, but it's a symptom of an improving economy. Interest rates are still very low, so they're coming up off a very low level. And there's absolutely no doubt that when you see the numbers in here about consumption spending, for example, Consumption spending in Canada over the past year has been bolstered quite significantly by the Canadian Child Benefit enhancement that was made exactly about a year ago. And that is one of the reasons why consumption will moderate a little bit in our forecast, because that will fall out of the data because there's no new enhancement, or 1 year later, which would be after the second quarter data are in hand. But at the same time, the infrastructure program is in the background, and I say in the background because there's only certain bits of evidence where it's already showing up, but we know the money's been allocated, and so that's something we can look forward to. That's in our model. That's an important part of this closing of the output gap, which is happening. It's not just interest rates that did this work, it's the fiscal part. So I'm not going to brag about it one way or the other, just the facts. The facts are there.
Can you take one more?
Yes, please.
Question?
Just while the Canadian economy was during the suffering the oil price shock, the narrative was it's quite a complex adjustment.
Yes.
And that the economy was actually more diversified than just energy, and that non-energy exports would be critical in the transformation. Can you give an update to that narrative and say sort of where the economy is after turning the page on the oil price shock, so to speak?
Yeah, so this is where I could brag on behalf of our staff, because at the onset of the oil price shock, there was considerable range of opinions on how the economy would respond. And what we said then was it would take about 2 years for the worst of the adjustment to take place, that it was complex, so we'd monitor it along the way. And we also said that the other 87% of the economy was likely to continue to benefit from the conditions that we found ourselves in. Because of the decline in the energy sector, the macro figures looked pretty weak through that piece, but by decomposing those things, we could show that the non-energy line was doing quite well. And so at some point, what happened was that would become the dominant trend in the economy once the energy sector bottomed out. In fact, that's what happened late last year. It did bottom out and began to contribute to growth again, especially in the first quarter, as Wilkins said before. So all that was a very difficult forecasting job, but I think very well done. And the fact that policy was able to act in a timely way to speed up that adjustment, I think, is to all our benefit. And so that's where we are now. It looks like the energy sector has, I don't want to give the impression that that's adjustment completely over, because there's certainly still plenty of adjusting going on. There are pain points. There are people still that lost their jobs and don't have another job and haven't recovered fully. So don't get me wrong about that. And we said that the other phase, the last phase of the adjustment, would be the so-called income effect, because we'd be getting $60 to $70 billion less per year as a country because of those lower oil prices. And that would affect everybody. Okay, it would spread through the entire economy. So this is one of the reasons we point to the subdued wage growth that we're observing. There are pockets still of unemployment, so there's competition for the next job. So you don't have, hot wages to attract people, not really. But underneath that, you've got people that were making very high wages in the oil patch who are now moving to jobs that are lower wages. And so those kinds of structural transformations, as well as the macro effect of labor market competition, suppress the adjustment of wages and make it a slower process, why the labor market will take longer to complete the adjustment, which is exactly what we've said here today. So that's the state of play. Things haven't stopped moving. It's still there. But it's enough in the rearview mirror now, and the big thing was the contraction of the sector. That appears to be complete, that companies can go on, obviously they would prefer a higher oil price to a lower oil price. But, in that sort of 40 to 60 kind of zone where we've been for quite a while now, that's kind of become the norm, and people have adjusted to that lower price by cutting costs and increasing efficiency. So.
This concludes our press conference. Thank you very much.
Thank you very much, everybody.
Thank you, Mr. Poloz.